Hi, it's Jeffrey Cohen, U.S. Advanced Computing Infrastructure's Investment Advisor Representative and President, Jeffrey Cohen, here to talk to you today about the inflation reading, the Consumer Price Index, published by the Department of Labor this morning, and also to talk about the debt ceiling and how those two things might come together. It's a little bit of a fantasy from us in a macroeconomic sense, but let's talk about it. And the inflation data, which came out today, basically was right in line with where it was expected. So what happened was, and by the way, you find this data by going to the U.S. Bureau of Labor Statistics, bls.gov/CPI. bls.gov/CPI. So Consumer Price Index is a measure of the average change over time of the prices paid by city dwellers for a basket full of goods and services. It includes things like gasoline, utilities, stuff like that. Services too, like haircuts, right? So all items are up 6.5%. Now the Fed has a dual mandate. They have to have stable prices, which has been defined as 2% or lower, averaging 2%. So it could be a little over 2, but it's got to average 2. Maximum employment, which we have. If you listen to President Biden, which I might play for a minute or two, because he talks about some of this stuff.
Good morning.
And then it's also number 3. It's moderate long-term interest rates, which helps the farmers, the business people, and the government raise money when necessary. A lot of what the Federal Reserve does now was negotiated in the Federal Reserve Act after the Great Depression and was driven heavily by southern states, which were agrarian states. So remember that everything the Fed does has a long tail from the farm areas. They want low interest rates. When the Fed raises interest rates, it goes against the very core of their federalist nature. So let's talk about it. Where are we, right? So Jeff, I see 6.5%. Food's up 10%. By the way, I know that. I'm dying when I go to the grocery store. I think we bought like 10 items for dinner, and it was so expensive. Energy is up 7.3%, but was down this past month. And all items, or the core rate, all items outside of food and energy is up 5.7%. And if you look, here's the actual news release that they give you. And they talk about how energy was down 4.5% over this past month because gasoline declined. That's great. Gasoline got cheaper. Now food got more expensive at 0.3%, which is almost a 4% annual rate. So the food thing I don't like. Gas, love it. You can see right here, food up 0.3. Food away from home is up 0.4. Food in the grocery store up 0.2. Energy, so much cheaper. Fuel oil and gasoline. But what's interesting is energy services, such as electricity and utilities, those are up 1.5% for the month, which is 18% for the year. So if you were having trouble paying your utility bill, it's going to be 18% higher a year from now if this month keeps going. So we're not done with inflation. It's just that gas is cheaper. Yay, gas is cheaper. But utilities are not. Used trucks and used cars went down in price, which is great. Shelter, rent, went up. Rent is up 0.8, which is about 10%. So if you pay $2,000 a month in rent now, it'll be $2,200 a month when they renew you in a year. It's not great. So we looked at the markets, and the markets was interesting. So by the way, any questions? So that's the inflation data. I just want to tell you the market originally did not like this reading. You can see NASDAQ and S&P dropped into the reading. And then it went up to start the day flat. Then it came up a lot. It came up like 20 points or 0.5%, and then it just dropped down. So the market doesn't really like this data. It wasn't great data. 6.5% inflation does not mean that we've solved the inflation problem. The other thing I saw, which I thought was important to show you, 1 month Treasury bill should be around the policy rate. Now the policy rate's 4.25. The 1 month Treasury is at 4.215, close enough for government. So what that means is if you go to give the money for the government for a month, they're going to give you 4.21 interest. They say that that should be 4.25. It's just close enough, right? If you want to lend the government money for a year, they're going to pay you 4.72% interest. That's a lot. That's great. But it's down a little because maybe people think that this CPI information was so positive that the feds aren't going to have to, raise interest rates a lot. Which, by the way, they don't want to do because it's a federalist system with a lot of legacy strength from the farm states and from manufacturers who need low interest rates, long low interest rates. And also the U.S. government, which is $31 trillion in debt that they got to pay interest on. They don't want high interest rates. And so what happened? Well, today, if I look at U.S. Treasury bond rates, and I'm going to blow this way up. I just hope it's easy to read here. So interestingly enough, the 13-week Treasury bill, which is a 3-month rate, dropped 9 basis points, or it's down to under 4.5%. So maybe people figure we're only going to raise by 1/4 point, so it's only going to be 4.5. So why would I forward buy and pay all this extra money and whatever? But I find it very fascinating. These are huge moves. The Treasury 5-year yield is down almost 14 basis points. That's 14/100%. That's 1/7%. That's a big move. That is a monumental move, right? And so what it means is that interest when you lend the government money, which is risk-free, is dropping a lot. You're going to get a lot less interest. So the bonds are worth more. This is really helpful for community banks that maybe have invested in bonds. And in investment banks that are using the carry trade, they've been buying bonds at like 3.8, 4.0, and now they just made a ton of money on their bonds. 10, 12, 14 basis points moves are big moves, right? So bonds are more expensive. The interest rate paid is lower. So this is what CPI did. CPI said, we're not out of the woods yet. This is an inflation reading is what this is. This is a recession reading is what this is. It says, I'm afraid, I want to put my money away. I want the feds to pay me interest for 10, 5, 30, 7, whatever, 30 years, 7 years, and I'm going to get my 5.5% or 3.5%, and I'm going to be happy. I'm going to earn 3.5% and be happy. Just think about that. That's crap, right? That basically says there's nowhere out there to invest. And that's what this inflation reading gave you. So what it said was the Fed is going to have to keep tightening. There's probably going to be a recession. We're in big trouble here. So now I want to talk about a related matter, which is what about the debt ceiling, and maybe there's something we could do about it. Jeffrey, you're a Republican. Do you like a lot of debt? Well, let's start by talking about it. U.S. Department of Treasury has a website. They make it simple, debt limit. The debt limit, just want to define it first, is a total amount of money the U.S. government is authorized to borrow to meet its existing legal obligations. So the debt limit is just how much money they can borrow to pay for existing legal obligations. And these are obligations that were made in the past that we've already spent the money. Do you know since 1960, Congress has raised this limit 78 times? So it's not like they don't do it. But it's funny because it always causes a little pause. Well, we borrowed $30 trillion. Maybe we should stop a while. I got a credit card somewhere. I don't use it very often. It's like in my drawer. Here it is. I have a credit card. I love my credit card. It's by Spirit. And I look at how much money I borrowed on the card. I look once a month when I get the bill. And I have to decide, is there a limit? Can I borrow more? Now, the card has a limit, but then I have my own limit. And so if I want to keep borrowing, I have to look at that limit and make a conscious decision. Do I borrow more or do I pay it off? Now, the federal government has a great opportunity. We just talked in a previous video that they're going to be raising money on corporate taxes, raising a lot of money, $200 billion of new corporate tax based on the Inflation Reduction Act. So what a fun idea. Maybe you take that $200 billion and you use it to pay off debt. It's not a lot of debt, just a little. 5 years, you paid off $1 trillion. It feels pretty good. But the other thing you could do is reduce the amount of money you're spending as a government. Just do it. I know it's not popular. Everyone loves a free lunch. I got to tell you, I love a free lunch. You know, I went to the store yesterday and I bought donuts for me and the family. I would have loved if they were free. Federal government's giving away free donuts. You know, they didn't give away the free donuts. But they might have, and I might have been really happy about that. Or a free car. I'd love a free car. Or maybe the feds want to give me a free house. Or gold bullion or something for, but you know what? Nothing's really free. Debt limit. Nothing's free. So let's talk about it. I got a debt limit. What is the debt limit, Jeffrey? Now I go to the Congressional Research Service. Published a note November 16 of 2022. You can find this. The debt limit. The current debt limit. Make it big so you can see it. The number is IN 12045. The current debt limit of just under $31.4 trillion was set in mid-December when it was raised by $2.5 trillion. It's actually $31.385 trillion. So that's a lot of money, right? And the funny part is, it's only taken us about a year and a month to borrow another $2.5 trillion. That's a lot of money, right? We're just gone crazy here, it feels like. $2.5 trillion. That's a lot of credit card bills, right? So let's go to it now. Here's my idea. So that's a lot of money, $31.4 trillion. The fact is that we're going to hit that limit pretty soon. So what happens when they hit the limit? Well, this is a note by the Department of the Treasury from January of 2022, where the Treasury Secretary was reporting to Nancy Pelosi in the House of Representatives what happened. So what happened was, in August, the outstanding debt subject to the limit was at the limit. And then there became a debt issuance suspension period. And it went till September 30, then October 18, then December 3rd, then December 15, and December 16. And on December 16, the debt limit was increased by $2.5 trillion. So the truth is that the Secretary can do a lot of things. They can sell or redeem securities, obligations, or other invested assets of the Civil Service Retirement and Disability Fund. Okay, so they can do that. They can do other stuff too, right? So they basically, $35 billion and $1 billion were redeemed in order to keep us above the limit. So less than 1 over 1,000, and we could manage our way through this crisis. And they knew from August 1st, they knew they had to start taking action. August, September, October, November, December and a half. 4.5 months they could operate in this environment. But I don't remember anybody ever saying, you know, we're going to cut spending. So on that day, August 1st, Congress could have said, you know what? We're going to stop spending a lot. I don't know what we're going to cut. It almost doesn't matter. We'll cut military. We'll cut Social Security, Medicare, Medicaid. We'll cut jobs, salaries. We'll stop spending. We'll sell the oil in the strategic oil reserve. We'll sell some federal land. We'll do whatever we have to. You know what? We'll raise taxes and we just won't spend the money. There's ways to do it. Just do it. And next thing you know, instead of having to raise the debt limit $2.5 trillion, we would have had a debt limit that was lower. It was lower. It was a lot lower. It was like $29 billion. We could have been at $29 billion today if we just would have kind of stuck to the guns a little, right? Stayed tough. We don't need all the stimulus. Now, here's the best part. If you don't spend $1 trillion and there's like $25 trillion in money out there, then you're cutting inflation by 4%. I'll go through the math again. But I want to go back to the Consumer Price Index. We're up 6.5%. If you could not spend $1 trillion a year on a $25 trillion economy, it's 4%. You just took 4% of money out of the hands of the economy. 4%. That's great. That's 4%. We only have 6.5% inflation. Now you got the Federal Reserve raising interest rates and doing quantitative tightening. You know, some guy in Twitter just said, look, have them do like $70 billion a month of quantitative tightening or $200 billion a quarter. And now you're taking $800 billion out of circulation, out of reserves. Excess reserves. So you did $1 trillion with the Congress. You do $800 billion with the federal bank. Now you raise interest rates. Maybe you squeeze another $500 billion out. You just took out inflation in 1 year and you just stopped all this mess so the stock market could keep going up again. But nobody's doing that. No one's talking about it, but I'm talking about it. Jeffrey Cohen, candidate for office, Republican from Illinois, in a district that is 90% Democrat or independent. So I don't stand a chance of really ever winning my office in my home district. But it doesn't matter. I keep trying. Because I believe in these kinds of things. Like if they could just tighten $1 trillion. Now, we got $200 billion that we're raising on corporate AMT, according to my Medium article that I just talked about. So it's really cutting $800 billion of spending because you're raising $200. This is not that hard, guys. You spent $6 trillion last year, 6.7. We're only talking a 15% cut. It's not a lot. Come on, do it. Do it. Cut $1 trillion. Spending net up from last year. Maybe it's more than $1 trillion. I don't know. Let the Fed do their job, and you just took inflation down to zero. And I'll tell you what that does for the average American consumer. Makes their life easier. It's great. So we're going to listen for a minute to what Biden has to say. If you're done watching the video, that's fine. Now's a good time to drop off. But Biden's taking like a huge victory lap here.
Today we've got some good news. Good news about the economy. For the 6th month in a row, inflation has come down. Measured over the last 12 months, it has fallen 6.5 to 6.5%. That's down from 7.1% the month before. It's down from 9.1% this summer. Inflation is now at its lowest level since October of 2021. When we look at just the last 3 months, we see that inflation fell to 1.8% on an annualized basis. It's down from more than 11% in the first 3 months of last year. So the data is clear. Even though inflation is high in major economies around the world, it's coming down in America month after month. giving families some real breathing room. And the big reason is falling gas prices. My administration took action to get oil onto the market and bring down prices. Now gas is down more than $1.70 from its peak. That adds up to a typical family with 2 vehicles to a savings of $180 a month, every single month, that stays in their pockets instead of being spent at the pump. Food inflation is slowing as well. Last month we saw the smallest increase in food prices in almost 2 years. And much of that increase was due to the avian flu outbreak, which has driven up the egg prices around in the United States. It's not just gas and food prices, though. When we look at what economists call core inflation, which takes out energy and food, we see welcome news as well. Core inflation is down to the lowest level in a year. Over the past 3 months, core inflation has come down to 3% on an annualized basis. That's down from more than 6% at the beginning of 2022. The cost of goods is actually falling, as prices from everything from computers to used cars are coming down as well. And inflation in the core services is moderating as well. And as inflation is coming down, take-home pay for workers is going up. Workers' wages are higher now than they were 7 months ago, adjusted for inflation. Wages for lower income and middle income workers have gone up even more. It all adds up to a real break for consumers, real breathing room for families, and more proof that my economic plan is working. When I came to office almost 2 years ago, the economy was flat on its back, as you all remember. Millions of people have lost their jobs through no fault of their own. Millions who kept their jobs saw the hours and paychecks cut. Hundreds of thousands of small businesses permanently closed their doors. People were hurting badly. That's what we inherited. The pandemic was raging and the economy was reeling. We acted decisively to put in place a new strategy that would rescue the economy from the pandemic downturn. At the same time, we laid the foundation for a stronger, more resilient economy for decades to come. An economy that grows from the bottom up and the middle out. Now 2 years in, it's clearer than ever that my economic plan is actually working. Here's what we've learned just last week. Unemployment is the lowest it's been in 50 years. I'll say that again, the lowest unemployment rate in a half a century. My first 2 years in office were the 2 strongest years for job growth on record. We created nearly 11 million jobs, including 750,000 manufacturing jobs. And there were 2 of the strongest years ever for small business creation as well. And today, unemployment rate is near record lows for blacks and Hispanics. Black and Hispanic workers near record lows. And it's the lowest ever on record for people with disabilities. We're seeing American families breathing a little easier. More Americans have health insurance than they did ever in our history. Fewer families are facing foreclosures today than before the pandemic. And we still have more work to do, though. But we're clearly moving in the right direction. And there's more breathing room in store for American workers and families. Starting last week, as of January 1, a month's supply of insulin is now capped at $35 for seniors on Medicare.
This is the part where I get a little worried.
Every month for their insulin.
Because Biden's going after very specific targets of the economy.
Big Pharma raises prices faster than inflation.
So he's going against pharma.
Starting last week,
he's picking winners and losers, as opposed to the general overall economy.
Like heat pumps or solar panels, or when they buy electric vehicles.
Now he's doing energy-efficient appliances and electric vehicle credits. What about the gas manufacturers, the internal gas combustion engine automobile manufacturers? What about pharma?
Investments in American manufacturing turn into new factories and new jobs from Arizona, Ohio, Georgia, New York. Companies have announced nearly $3
federal investments in manufacturing. I mean, great.
Here in the United States.
But you're picking winners and losers again.
Instead of exporting jobs like we did for decades,
and I'm thinking about the fact that Pennsylvania, Wisconsin, which are heavy manufacturing states, voted for Trump. And so it could be that Biden is going after it in order to win the next election. It feels like politics.
or any Republican Congress to make progress for the American people. But like many Americans, I was disappointed that the very first bill the Republicans in the House of Representatives
All right, we're going to stop now.
Would help wealthy people.
Because at this point, the president goes away from the economy and about inflation, and he starts attacking his political opponents. And at this point, that's not what this video is about. So I want to thank you guys for watching. I appreciate it. My name's Jeffrey Cohen with Chicago Quantum, which is the brand name for U.S. Advanced Computing Infrastructures, Inc. And we're a consulting firm. We're here to make money. We have different services that we sell. And if you like the work that we do, we would love it if you could support us. Buy a run, it's $750. Buy a week of custom development work. We'll build models for you. And there's other things as well. We have an updated brochure. And you can call a cell at 312-515-7333. And if you were to call now, this phone would be ringing. So, it's a pretty old phone, by the way. I want to say it's like 6 years old. So, buy some services. Maybe I'll buy a new phone. Maybe I'll sound better. All right. Thanks again. Thanks for watching. Appreciate it. Again, Jeffrey Cohen, Chicago Quantum, talking to you about CPI and about how it did not make the stock market go up or down. It was kind of as expected. And this great idea we have to use the debt ceiling limit as a catalyst to reduce spending, which would almost immediately bring down inflation. Thanks so much. Bye-bye now.